Hello, everyone, and welcome. I'm Kara Bloomberg, COO of Landrum HR. Thank you for joining us today. We're going to cover as much ground as we can on PPP forgiveness and all of the important factors you need to consider. Our goal today is to give you the information that can help you make the best decisions for you. We want to point you to additional resources and continue to bring you webinars as details and info are available. A link to this recording will be sent to all who registered today. Many of our attendees are clients today, and welcome, but for those of you that aren't familiar with us, Landrum HR is a nationwide human capital services company. We also offer full-service HR outsourcing, or PEO services, worksite management and staffing solutions, and insurance. Our HRQ division provides human capital consulting, places interim HR talent, and conducts searches for HR professionals. You can find out more about all of our services by visiting our website, landrumhr.com and hrqinc.com. Today, you can submit questions using the questions pane on your control panel. We will try to get to some questions during the Q&A session at the end of the presentation. I know we have a lot to cover. We certainly will try to connect with you if we don't get to your question live. I'd like to introduce Amy Remington, General Counsel for Landrum HR. Amy has spent the last 15 years of her career at Landrum HR. Amy has over 20 years in the employment law arena, and she's a national speaker on employment law topics, and now a resident expert on all things PPP. Amy, I know you've got a lot to cover. Let's get started.
Thanks, Kara. Thank you to all of our participants for joining us today on this COVID update. This is the 7th webinar in our series of COVID legislation updates. And I'm going to start with a very quick refresher on the 2020 COVID legislation. The 2020 COVID legislation started on March 27th when Congress passed the CARES Act, which was the Coronavirus Aid, Relief, and Economic Security Act. That was actually phase 3 of legislation that addressed health and economic effects of COVID-19, and it provided $2.2 trillion in direct payments to taxpayers. It provided for expansion of unemployment benefits, and it created the Paycheck Protection Act, the PPP, that we're going to talk about today. So as a result of this legislation, businesses with under 500 employees, many of them applied for loans with the hope that all or part of that loan would be forgiven and it would help them stay afloat during this time. And then in May, about 6 weeks later, the SBA, the Small Business Administration, released the PPP loan application forgiveness, the actual document that you would have to use, and it contained several parts and several subparts. And to be honest, it was incredibly complicated. It is incredibly complicated. There was also loan application forgiveness guidance that was issued from the Department of Treasury and from the SBA. And then following that, there were additional guidances released. And then in June of this year, just a couple weeks ago, the PPP Flexibility Act was passed by Congress because Congress recognized that some of the complications of the CARES Act created hardships for employer borrowers. So it amended the CARES Act by passing the Flexibility Act. And many of the amendments actually benefit you, the employer borrower. And then finally, on June 8th, just 3 days after the Flexibility Act was passed, the Department of Treasury Secretary Mnuchin and SBA Administrator Carranza issued a joint statement regarding the PPP Flexibility Act, which changed the act a little bit. So to try to clarify all of this and distill this, we are going to talk about the CARES Act, the Flexibility Act, and the joint statement and tell you what the latest information is about each so you know what you need to be looking for with respect to any loan that you have or that you're seeking. Now, I want to say at the outset that I have no doubt that the current loan forgiveness application will have to be amended based on the Flexibility Act. It's simply, there's too many changed terms, and there are key terms that have changed and key calculations that have changed. So it's going to have to be amended, and we don't have a date for the application amendment yet. So our theme today is going to be for every listener, every employer borrower, to take a well-deserved pause and breathe just a little bit. You deserve it. I know that all employers have been running at full steam since February, trying to ensure that their businesses apply for and receive loans and stay healthy. So this little breather is welcome, and we actually have some time to consider the CARES Act, the Flexibility Act, the joint statement, while we wait for the new application to come out. So let's just dive right into some deadlines. The first deadline is the Flexibility Act and the joint statement referred to the application covered period and a deadline to apply for a PPP loan. But to make this really simple, what you really need to know is that June 30th is the deadline for both the application for a PPP loan and for the origination of the loan. So you have until June 30th to both apply for and for a lender to originate a loan. So if you haven't gotten a loan and you want to get a loan, you probably need to jump on that pretty quickly so that your origination date can be before June 30th. And the good news is there is still money available under the program. Now, if you've already applied for a loan, this June 30th date does not mean that you can apply for a second loan at any time or that you can seek additional monies under your original loan. And that's true even if you didn't apply for the full 2.5 times payroll of the loan amount. You are married to the one loan you have, but if you have not applied for one, there's still money and there's still time to get one. Now, there was another, there's a covered period, and as I just mentioned, there's an application covered period, but the other covered period that was referred to in the legislation and in the forgiveness application, and that I have no doubt will be in the new application, is called the loan forgiveness covered period. And a lot of people, when they talk about it, they just talk about the covered period. But what we're talking about when you see that is the period of time where you can incur expenses that will be forgiven. And don't forget, these expenses are ones we talked about in prior webinars that include your payroll costs, your rents, your lease payments, and even monies that you paid to employees who were furloughed so that those employees could continue to get wage continuation. So under the CARES Act, you had to incur all of the expenses within 8 weeks of the loan origination date. And so a lot of employers got their loan and then struggled to make sure they paid it within 8 weeks of the loan origination date. And then the SBA came along and added this alternative covered payroll period that we just spoke of. But under the Flexibility Act, and this is the latest and the greatest, so this is what I want you to think about. Under the Flexibility Act, your covered period depends on whether you are a new borrower or an existing borrower. And a new borrower means you don't have a loan and you didn't have a loan before the enactment of the Flexibility Act. So if you did not have a loan before June 5th, then you're a new borrower. And that means you have to use the earlier of 24 weeks from your loan origination date or December 31st. Now, if you're an existing borrower, say you had your loan prior to the Flexibility Act, which many employers did, especially if they applied when the loans first became available, then you can use the original 8-week period, or you can use the earlier of 24 weeks from the loan origination date or December 31st. So the good news is that this December 31st option gives employer borrowers about 6 extra months to pay eligible expenses with your PPP loan money. Now, what's not clear to me, and what I hope will be cleared up by the SBA or Treasury, is whether a borrower who uses the 24-week period and then seeks forgiveness after the loan monies are spent, but say the loan monies are spent before the 24-week period, so maybe you spend all your loan money in 12 weeks. It doesn't take you 24 to spend all your money. It's not clear whether you can apply for forgiveness before the end of the 24-week period or whether you have to wait till the end of the 24-week period. But I suspect when we get a new application, we'll know the answer to that. And also, since the loan application and origination date now closes on June 30th, it should be entirely possible to use all the monies within 24 weeks during the 2020 year. So that's good. But making the decision, if you're able to make the decision between the 24-week period and the 8-week period, you need to be mindful that you have an obligation to maintain your employee headcount and not reduce salary or wages during the period that you choose. So these two periods are important for you to sit down perhaps with your CPA or your trusted advisor and determine how best to spend your money and in what amount of time. The other thing that has changed was the definition of a full-time equivalent employee. So under the CARES Act, that was not even defined. They didn't say what a full-time equivalent employee was. And then SBA and Treasury said, well, a full-time employee is anybody who works 40 hours or more on average per week. And then the Flexibility Act adopted that and agreed and said that a full-time employee is somebody who works more than 40 hours a week or 40 hours a week on the average. So now if you had an employee who worked part-time before, say they worked 20 hours before and they worked 20 hours after, and they didn't sustain a reduction in hours because their hours haven't changed, then your score on your PPP loan application will not be harmed even though they're not full-time. But what they don't want to happen is to have people who traditionally work 40 hours be reduced to 30 or 20 hours. So that's just something to keep in mind. There's also what they're calling the full-time employee reduction factor exception. And that's kind of a complicated name, but here's what that means. So all borrowers would love to have 100% of their PPP loan forgiven. However, the amount of forgiveness can be reduced to some smaller percentage based on the number of employees that you bring back at their prior number of hours and their wage. So the full-time reduction factor looks at the full-time equivalent score for each employee over the course of the loan forgiveness period. What that means is if you laid employees off during the covered period, there's going to be a reduction to your loan forgiveness amount. However, there are some exceptions to this rule, meaning that the amount of loan forgiveness would not be reduced. And the SBA addressed this, but then it has changed a little. So what you need to know is that under the Flexibility Act that contains language that says that a borrower can avoid reduction of forgiveness amount if they can document that there was an inability to rehire and that the inability to rehire similarly qualified employees by December 31st of this year. Or if they can show that they are unable to return to the same level of business activity as they had pre-pandemic, which is considered February 15th, because of COVID-related things. So for example, if you are a restaurant and you are not allowed to operate at full capacity, or if you're a church and your services have not resumed because of social distancing rules, or maybe you're a specialty doctor or dentist office and you have not resumed because of the CDC or the OSHA guidelines, then you could show that you're unable to return to the same level of business activity as you had on February 15th because of COVID. And that would mean that you could avoid the reduction in the forgiveness amount. So that would be a good thing. We'll have to see how the new loan forgiveness application addresses this, but I do believe it to be good news, along with a lot of this good news today, that Congress understands some of the limitations that employers have. Next, let's talk about the full-time employee reduction safe harbor rule. Now, this relates to the total number of employees that you have. So the CARES Act said that to avoid a reduction in the forgivable amount, the employer had until June 30th to increase their headcount up to pre-pandemic levels. So you would look at where you were on February 15th, and then you would have until June 30th to get back to that number. Well, Congress recognized that because a lot of businesses are closed, and maybe this is the effects of COVID and the rules regarding social distancing are taking longer than anybody anticipated in this new era that we're in. So what Congress said is that your forgivable amount will not be reduced if you can increase your headcount to pre-pandemic February 15th levels on or before December 31st. So you have another 6 months to increase your headcount. So that's another kind of breather that you can take so you don't have to be in a rush until the end of this month to increase your headcount. Now, what I don't know is if that is looked at in a snapshot in time or if it is looked at on December 31st. So say, for example, you had 30 employees on February 15th, and you now have until December 31st to get 30 employees back to work. Well, say you were able to do that on October 1st. So during the period, you were able to increase your headcount, but because there was a second wave of this or for some other reason, on December 31st, your headcount is actually below 30. I don't know if they're going to look at that date on that snapshot on that particular date, or if it's at any point during that period. So we'll have to see about that. But the good news is you do have 6 extra months to get your headcount up to pre-pandemic, pre-February 15th levels. So it gives you another way to breathe. And then finally, kind of on the same note, there is a salary hourly wage reduction safe harbor. And this relates to hourly and salary wages. So under the CARES Act, to be forgiven, you had to restore an employee's salary and wages as they were on February 15th by June 30th. And again, just like we just talked about with the other one, this date is now expanded till the last day of this year, till December 31st. So if you can restore salaries and wages as they were pre-pandemic on February 15th, by the end of this year, you'll have loan forgiveness. So this is especially good for businesses that are in states like New York and other states up north where there are a lot more businesses that continue to be closed and that are not able to reopen. So this is especially good in those types of states. Okay, so next we're going to talk about the 75% rule. And this is an important rule, and it's a little bit complicated. So I'm going to go through this and just kind of tell you the history so we can talk about where we end up. So under the CARES Act, I mentioned that the CARES Act allowed certain uses for your loans: payroll expenses, mortgage, utilities, rents, lease payments, and even, like I said, to pay furloughed employees. But the CARES Act didn't say how much of your loan must be spent on payroll costs, how much of your total loan had to be spent on payroll costs. So a lot of employers were like, gosh, well, I will spend as much as I can on rent and utilities, and then whatever's left over, I'll pay to employees. Other employees were like, well, I want to maximize my employees, so I'm going to try to do some bonuses and make sure employees are well taken care of. So it just wasn't clear. And then SBA and Treasury, in their guidance, came along and said, well, to get 100% forgiveness, at least 75% of your loan must be used for eligible payroll costs. And employers were struggling to meet this 75% amount. So say you took out $1 million loan, it would mean that at least $750,000 had to be spent on payroll. But if you didn't meet the $75,000, if you didn't pay $750,000 of that $1 million in payroll, you would still be able to get some forgiveness. So say you had $1 million loan and you spent $400,000 on payroll, then you get a 40% forgiveness. So there was a proportionality to it. Well, the Flexibility Act reduced the threshold to 60%. So that was good news, right? It reduced it to 60%. It said you must only spend 60% of the loan to get forgiveness. And the intent was that it'd be easier for employer borrowers to hit the goal of 60%. But the way the Flexibility Act was written, the unintended consequence was that if you didn't spend 60% on covered payroll costs, you might get zero loan forgiveness, which is not, I don't think, what Congress intended. And Congress is aware of that. So the joint statement came out and clarified that if a borrower employer uses less than 60% of the loan amount for payroll costs during their covered period, they will continue to be eligible for partial loan forgiveness. So we'll have to see. I do believe that this will be clarified. It's not completely clear right now what the consequence of failing to use at least 60% of your loan on payroll costs is. But I do believe Congress will clear this up. I do not believe it was Congress's intent to say, well, gosh, if you don't spend 60% of your loan on payroll, you get zero forgiveness. That's not consistent with anything that we've seen in the past. So I think that will be cleared up. But the good news is it has been reduced to 60%, and I can't imagine Congress raising it back up to 75%. So that should provide a little bit of more breathing room for borrowers. And then the other thing that has changed is the loan terms. So the CARES Act, you'll remember we talked about the fact that you had a maximum of 10-year loan terms. And then SBA said, well, no, wait, they're going to be maximum of 2-year loan terms. Well, the Flexibility Act came along and clarified that the maturity period must be a minimum of 5 years and a maximum of 10 years. And this is not retroactive. This is one of the few provisions that's not retroactive. This provision does not apply to loans that are already made unless the lender and the borrower otherwise agree. So there is no harm in asking your lender if you want to modify your terms, but the lender does have to agree. So right now, the rule is a minimum of 5 and a maximum of 10 for loan terms. And then for loan deferral, so of course, this applies to your payment and your interest and your fees. So the CARES Act said that your loan deferral period was not less than 6 and not more than 12 months. And so what that meant was that borrowers could potentially have to make their first loan payment without knowing how much would be forgiven. And that's really problematic if you've made some loan payments and then you subsequently find out that 100% is forgiven. So SBA and Treasury changed that and said, well, gosh, deferral will start 6 months after disbursement of the loan. And that didn't really clear it up. So what the Flexibility Act did to clear it up and make it a little more breathing room for employers, this is another benefit, is they said that deferral will be at the earlier of the date loan forgiveness is remitted by the SBA to the lender. So in other words, when SBA tells the lender what the forgiveness is, so that's going to have to be, of course, after the forgiveness application comes out, after it's reviewed, after it's approved, and then after the lender finds out. So that's good. So it's pushed in the future. Or if you happen to be a borrower who's not seeking forgiveness, 10 months after the close of the loan forgiveness period. So both of those are good, but it does give a little more breathing room. The date the loan forgiveness is remitted by the SBA to the lender is a broad date. So that's good for all of our employer borrowers. One question we have gotten quite a bit of is about the $100,000 cap. And the question has been, well, gosh, if there's now a 24-week period, does that mean that instead of a $100,000 cap, it's 3 times that amount, or has that changed at all? And the answer is the $100,000 cap on annual salary does not change, but it can be annualized differently if you choose a 24-week period rather than your 8-week period. It still exists. So $100,000 is still your maximum. And then the last significant change was the Social Security tax deferral. Under the CARES Act, employers could defer their Social Security taxes that were accrued between March 27th and the end of this year, December 31st, and they could pay half of that amount on December 31st of 21 and the other half on December 31st of 22. So the good news is the Flexibility Act makes it clear that this tax advantage is available for any Social Security taxes that were due to the IRS before and after forgiveness. So that's another thing that does help all of our employer borrowers. So your takeaways for today, if I were seeking forgiveness of a loan, here's the couple things I would do right now. So number one, I would make sure I was keeping contemporaneous and detailed payroll records for each of the 8 or the 24-week periods, including all compensation of all forms, whether it's traditional W-2 wages, whether it's a 1099 going to an independent contractor, whether it's straight hours, overtime hours, commissions. I would keep track of all compensation and hours worked for employees during the period of time, because again, you don't want a reduction in headcount. you don't want a reduction in hours, and you want to be able to support it with compensation records. I would also make sure that my tax forms, like my 941s, all match up to support the compensation that I've paid to the employees. I would make sure that my documentation for my employer contributions to benefit plans, like retirement plans or medical plans, are in alignment with all of the other tax documentation that I have. And even though this sounds really, really boring, I would probably take 45 minutes and sit down and read the current loan forgiveness application. Because even though the new application will have to change, the current loan application will probably form the basis of the new application. And so I would want to have some understanding of the different tables and the different schedules, so that as I'm gathering my data and scheduling hours and maybe even hiring employees, I can be mindful of where they might fit in those schedules and tables to help support forgiveness of hopefully all the loan monies. And then finally, this is a great time for you to go to your lender and ask them what they're going to require in terms of details and backup support. Most lenders that we've talked to have said that they will gather forgiveness information in electronic manners. And it sounds like lenders are going to have different questions that they're going to ask and different ways to submit information. So you have to learn what your lender is looking for and how they want you to submit the information. I would ask whether there are any changes to your loan terms as a result of the Flexibility Act, and to see what they anticipate in terms of their requirements for the loan application, for the documentation submission process, so that you can get ahead of that as well. So Kara, with that, do we have any questions that came in while we were talking?
Oh, Amy, we've got a lot of questions. So great job. Just, an incredible amount of content in such a short period of time. And I know there's a lot of specific questions coming in live on people's particular situations with employees and the number of hours of work and how they count. So, one of the most important ones, because I've seen it a number of times, is about employers hearing that they won't actually even have to fill out a forgiveness application, that it's going to be automatic in some way. Any truth to that?
So I have read that too, and I've read that from credible news sources. The amounts have differed. I've read that it might be $75,000 and below. I've read it might be $150,000 and below. So I don't know whether that will be the case. I do believe that if you were to get automatic forgiveness, your chances of being audited would go up much higher. So I would still recommend that anybody who is who has gotten a loan or is going to seek a loan and who is seeking forgiveness, treat it as if there is going to be a loan application for forgiveness and a subsequent audit. I mean, you need to make sure that all of your ducks are in a row, because if I were the IRS and I were choosing who to audit, I would probably choose those who, if there is automatic forgiveness, those who got automatic forgiveness first, to make sure that everybody has clean hands. And I do believe that the SBA and the IRS will be very, very proactive about auditing this money so that there's not something that happens 2 years down the road where they find out that X percent of the money spent weren't spent on wages as it was intended to do. So I would, if there is no application, that's wonderful, but I would still anticipate an audit.
I think a lot of questions too around, should I just be waiting and not applying right now for the loan forgiveness? And I think from what we're hearing, this new application, it's going to be important to wait for that.
Yes, I agree. We need to see what that says. But again, I mean, if you just need something to help you fall asleep at night, or if you just want to get really ahead of the game, I would take 45 minutes and look at the current loan forgiveness application if you haven't done that, because it was incredibly complicated. And, you want to have some idea as you're maintaining records of what your ultimate goal will be. for submitting them and what it might look like.
And Amy, last question. I know we're here at the end of our 30 minutes, but we had a number of questions from employers that I think are nervous about making employee changes right now. And I just wanted to have you address, someone needs to let an employee go for performance issues. There seems to be a lot of nervousness around making those types of decisions if they've received a PPP loan.
Yeah, so everything I've read talks about total employee headcount. And I know some small businesses who have employees who are hesitant to return to work, so they're not able to replace those specific employees, but they still can fill the position with somebody else. So everything that I've read talks about total employee headcount and total employee hours, not whether this particular employee is doing this role or that role. But you're looking at the big picture, the total employee headcount. So if you need to put somebody on a performance plan or even let them go, this does not provide them any insulation from that.
Well, Amy, from the questions that we have coming in, I anticipate that we will be here again shortly and hopefully addressing a lot of the questions that are arriving from this webinar. Definitely a lot of confusion out there. So I'm sorry that we're at the end of our time today, but thank you so much, Amy. Thanks for all of you for attending. Everyone who registered is going to receive a recording of this webinar, and please take a few minutes to answer our survey that's going to pop up as you leave the webinar. On behalf of Landrum HR, thank you so much for joining us today.